Hello, everybody. Welcome to the Trading with Ashley show. I'm very happy to bring you this video today because this is going to be great for beginners, for those that are interested in getting into the game of selling options, but you're just not sure where to start. Now, there's a couple of different dynamics that you probably heard of. One is called the wheel strategy. And the wheel strategy is when you are selling puts, you get assigned on a stock and then you start selling covered calls against that stock. And it's a great strategy. It's actually where I make my bread and butter for income generation. But there's a variation of selling options that is really wonderful for building up one, your confidence, and two, your account in short order. So I have been doing these with my trading community this last week, and the couple of plays we took ended up giving us a 38% monthly return. And it's a wonderful strategy in a market like we're in right now that's choppy and you're not certain if a stock's going to soar up or if it's going to pull down. So this strategy works really well if you are trying to get a quick win. And so I'm going to take you through step by step how to do it. It's called the buy right. So it's not the wheel strategy because, again, the wheel strategy is selling puts, waiting till you're assigned, and then selling covered calls. This strategy is different. This involves actually buying 100 shares of a stock and then immediately selling covered calls against that stock with the intent of the stock being called away. So you're getting a little bit of money on the actual premium itself, and you're getting a little bit of money on the call away because we're not too aggressive on these because the idea is to actually have the call away happen. That's what boosts your returns in the short term. Now, there's certain setups that work best for the buy right, and I'm going to take you through that particular setup. And I've actually identified 5 stocks that right now are at the perfect point in their price life cycle to execute this strategy. This also works well when the VIX is a little higher, like we're experiencing right now. And the reason is when the VIX is higher, traders are more uncertain about the market and what's going to happen with their favorite stocks. That actually increases premium. And so the VIX can be too high, and this strategy wouldn't work. You'd get tons of premium, but it's just too erratic for you to know if your share is going to be called away or not. You decrease the odds when there's that much erratic behavior in the stock market. And if the VIX is too low, it's a good strategy, but you're not going to get enough premium to have those larger returns. So right now seems to be the sweet spot for this strategy, and I wanted to make sure you fully understand it. Now, the stocks that I've selected for you, they're very reasonably priced, so you should be able to start flexing your muscle doing options, and this should help you get into the options game. Options, selling options are a wonderful way to build your wealth, and this should be available to everybody that wants to get into the game. So I hope this video helps you. Let's get into the details, and I'm going to teach you the basics of the buy right. I want us to first evaluate each of these stocks on their technical analysis, and I will show you why I think they're at a very good point to start the buy right process. So right now we're looking at SoFi. Currently, as of this date, it's trading at around 1280. So one thing you want to consider is where it is in its Bollinger Band. Now, this works very well when a stock is at about the middle of its Bollinger Band. And the reason is it's got more than likely some upward momentum that will happen that will assist in the call away feature that you're looking for. And you do want to consider where it is. If it's down this low, you could do it, but if it is down this low, you may not get that upward momentum because the RSI would be really low, and we don't know that it's going to recover anytime soon. Right here, when the RSI is close to 50, it shows that we do have some upward movement happening. The best time would be if it's slightly over 50, but this is close enough for us to do the trade. Now, the other thing to consider, what if it's right here at the top of its Bollinger Band? Well, if it is, then there's a good chance it's going to retreat. So this would be kind of a challenge for you because you may go ahead and write the call, but then it retreats and you don't get the call away. And that would be okay because you could rinse and repeat, but once a stock is at the top of its Bollinger Band, it will more than likely retreat. So you might be holding that a little bit longer than you had planned to. So this is a good one to look at. Right now, again, it's trading at about $12.87. So when we do the buy right, we would need enough cash in our account to purchase 100 shares of SoFi at this price. So right now, that would be about $1,287. And then we'll go select a strike price when we do the trade. And if you're looking at the Bollinger Band, you kind of want to get a sense for where a potential strike price might be. Most buy rights do pretty well if you anticipate about a $1 movement up. You can also check the deltas to ensure you have a higher chance of a call away. I'll show you how to look at the deltas on an option chain. I am evaluating SoFi on an option chain, and this particular option would be 1 week out. So what we want to do, we want to go down to the chain, and we're looking at the calls. And if we were to purchase it right here around that 1280 mark, these are our options for writing a covered call against our shares. Now, typically when I am operating the wheel strategy and I'm doing covered calls, I look for a delta around 0.2. But for this strategy, you want to be a little bit more aggressive because the intent, like I said, is to have it called away. So you could look at the 13. That's a 0.45 delta. Generally, what you're looking at is there's about a 45% likelihood that it will reach this $13 strike by your expiration date. Now, if you wanted to enjoy a little bit more price appreciation in your stock, because remember, you have 100 shares, so each dollar it goes up, you get to enjoy another $100 on the call away. So you might want to choose something right here around 13.50. That delta is a little bit lower, it's 0.26, and you're getting a little bit less premium, but you will get more if the shares are called away. So you could decide on either one of these. If you want a higher likelihood of the shares being called away, you'd stick with a 13 and you would accept double the premium for this trade. Or you would count on it going a little bit higher in price, take this $13.50 and accept only the 13 cents a share. So when you're dealing with this, you're looking at something per share. So 13 cents a share would actually be $13, and here you're looking at $30. Next, I'm going to take you to a platform that allows you to do this all in one trade. Now, you don't have to do it all in one trade. You could just buy the shares and then immediately turn around and sell the covered call. But I am in the Fidelity platform. So what you would do in this platform is you would go ahead and populate your stock right here. And then you would go to More Strategies and you would go down to the Buy Right. And then your action would be to buy the stock, 100 shares. And then we're doing a sell to open call. You put in your expiration. So we're going to look at the 28th. And then here's where we decide on our strike. If I was going to go ahead and go with that $13 strike, let's evaluate it to see what it would look like. Let's assume we put in a net debit order of $12.50. Now, the reason this is showing you a net debit is you are having to purchase the stock, but you're immediately getting premium for the covered call dynamic. So as you can see right here, what you'll gain on this trade is $50. And what that $50 is comprised of, it's two things. It's the premium that you're receiving up front for writing the call, selling the call, and it's also the appreciation of the stock going from the price that you purchased it at to the price it's called away at $13. Now, it's showing you your max loss is $1,250, but I want you to be aware this can only happen if SoFi goes to zero by your expiration date. So I don't want that to intimidate you too much, but one thing that could happen is it could not have a call away, then it could have a dramatic drop, and so you're left holding the stock, waiting for it to recover again. So that would be the potential risk, but I want you to fully understand how this looks so that this $1,250 doesn't intimidate you too much. Now let's look and determine how you can calculate your annualized return with trades like this. So the way that I like to do this is I like to take the $50 gain that I'll be receiving for the trade if it's called away, and I like to look at how much it cost me to put the trade on. So in this scenario, I would take $50 and I would divide it by $1,287 because it's requiring that amount of capital to buy those shares. So if I do that, that equals 0.038. I multiply that by 100 because that is going to give me my percentage. That's 3.8% in 1 week. Now, if you then consider we have 52 weeks to get your annualized return, you'd multiply that by 52, and that equals 197% annualized return, which is an incredible return. So let's look at our risk for the trade. Now, you could take a temporary loss in the trade, meaning let's assume our strike price is not breached and it's not called away, and then SoFi tanks in between the time of that strike not being breached and the time that you could write a new covered call. Well, in that case, you'd have to hold on to the stock until it went up again to a price where you could start selling covered calls again. So that would be your potential risk. So you want to do this on a stock that you believe in the longer term is definitely going to be bullish, because if it did retreat, you want the opportunity to sell covered calls in the future. Let's look at our potential second trade. It's perfect for this strategy right now. We are looking at it right here at the middle of its Bollinger Band. It's also very close to 50 on the RSI. So this would be the perfect time to go buy 100 shares and then go ahead and sell covered calls against them. Let's go see what it looks like. Hood is currently trading at $44.36, so you would need $4,436 to make this trade. And if you look at trying to select a strike price, let's look on the option chain to see what it's offering. Now, with this stock, it's offering a lot more premium, so this is going to be a really good return, especially if our shares are called away. Let's look right here at this $45.50 strike. It's a 0.41 delta, meaning there's about a 41% chance it actually takes it away with this strike price, and it's paying generously. It's $125 a share for selling this covered call. So let's put it on a ticket and see what our return would be. If you go with the midpoint, this is showing you the dynamics of the trade. You would receive $229 if your shares are called away. Your max loss would be $43.21, but again, that is if Robinhood goes to zero after you purchase the shares. Following the formula I gave you, this will be a 5.16 return, and if you annualize that, it would end up being a 268% return. Now let's see how the scenario changes if I go down in strike price for my call away to increase the chances of a call away. If I change this to 45, now let's see what it's offering. Here, you'll get 200 in max gain. So this is going to change the scenario a little, but you increase your chances of a call away. Weekly, this would be a 4.5% return, and annualized, it would be a 234% return. So if you want it to be more conservative, you would go with a strike price that's more likely to get called away. Let's look at our third stock. This is HIMS, ticker symbol HIMS. And again, it's right there almost to the middle of its Bollinger Band, not quite. And our RSI is close to 50, but not quite there. So this might be one that's ripe for the buy right strategy. Looking on our option chain, and if we look at our deltas, this 35 at a 0.49 delta may be a really good spot, or we could be a little bit more aggressive on our call away and do 35 at 50, and that delta is similar. It's about 0.45. It's offering $1.38 in premium at this point. If we go with the 35.50 call away, this is going to give us a $192 gain on the money we put up to make this trade. So that would be a 5.5% return this week, and annualized, that would be a 287% annualized return. Now, for those that have a little bit more capital, let's take a look at Palantir. Now, Palantir is trading really towards the top of its Bollinger Band, but it's a very tight Bollinger Band, and it is about 52 on the RSI, so there is room for this to go up. So if you wanted to do this trade, I might be more conservative with my call away just to ensure you do get the call away. The top of this band is right there at about 93. And so let's go see what it looks like. So let's look at Palantir on the option chain. If you consider we're purchasing our stock right here, let's look at maybe that $92 level, because that's a 0.46 delta. And look, it's offering such a generous amount in the premium. It's $268 for the call away. And that does not even count the appreciation of the stock being called away if you're purchasing it here and it's called away at 92. Let's see what it looks like on our ticket. If we put on this trade at this point, we would gain $345 on the call away, and then our max risk is a little more because this is a more expensive stock. So if you're looking at a weekly return, this would be 3.79%, and annualized, it would be 197% return. Now, be aware of the risk with these more expensive stocks because the fact that this is trading a little bit higher in that Bollinger Band, it has more of a likelihood of retreating, leaving you holding Palantir. But the beauty of a stock like Palantir, it does have quite the bright future, and it could pull back and you could be holding it for a bit if you do this trade. But then again, once it starts going again, you would be able to realize quite the appreciation in the stock. So one thing I like to tell individuals if they're looking at doing this, and let's say Palantir is a stock you do not want called away, then you may do this strategy to gain some traction and get some cash in your account, but have a separate account that you just buy and hold the stock so that it can continue to appreciate while you're generating cash on strategies like this. And finally, let's take a look at Tesla. Tesla is not quite to the middle of its Bollinger Band on the 3-month band, and it is under the 200-day moving average. But it has been trading sideways now for a couple of weeks, so that's something to consider. We're not quite to the 50 on the RSI, but we are heading that way. And you see this volume bar right here showing that there is some buying pressure on the stock. So this one will probably give us really good returns because Tesla always has high volatility. So let's take a look at a potential strike price for the call away. Wow, this is pretty exciting because the premiums are very significant. So let's look here at the 252.50 strike. The delta's 0.45, and it's offering us $688 for the call away at this level. Now, this one does require a lot more capital, but you will receive $995. But from a return standpoint, it would be a 4% return weekly. And then looking at annualized return, it'd be 208%. Now, let's see how this changes if we go down in strike to 250. Doing this will increase your chances of a call away, and the return will be 3.45% in a week, and annualized, that would be 179% return. But again, an extreme word of caution if you are going to trade a stock like Tesla, with everything going on with Tesla right now and the fact that it's a little anemic, it's still under its 200-day moving average, there could be more downside. So you want to be fully aware of that. I hope that was easy for you to understand, and now you're motivated to go and try this strategy on a few stocks. Remember, start slow. You don't want to go throwing all of your money into any one stock as you're practicing. You want to go slow and steady. Remember, slow and steady does win the race. Now, if you liked that, I also selected another video for you that talks about the wonders of the covered call and how it works so well to build wealth. So I'm going to attach that video right here. Remember, if you're with me, Trading with Ashley, there is no trader left behind.